from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Caroline Hyde in New York, in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour. Apple soaring on results that sail past Wall Street estimates. This is the Nasdaq 100. Managed to jump 3% to end the week. Still set for its worst month since 2008. Plus, 1 year on is the meme stock phenomenon that put Robinhood in the hot seat, fizzling out. We'll talk about the future of the retail trader and more. And trademark infringement versus the First Amendment. It's the first big battle over NFTs. How the case involving Hermes bags could set a new precedent. We'll get to that in a moment. We also want to be bringing you some breaking tech news. This all regarding HPE. Of course, Mike Lynch, UK tech tycoon, UK government approving the extradition of Mike Lynch to the United States to face some criminal fraud charges. That's after we just hours ago heard the London judge ruling that the tech tycoon was dishonest in that $11 billion sale of his company to Hewlett-Packard Enterprises. We'll get much more on that in a moment. But now let's go back to the markets, because we ended Friday on a positive footing. Tech leading the charge. Bloomberg's Ed Ludlow walking through an extraordinary week.
An extraordinary week, a volatile week. Don't worry, Caroline, we can breathe a sigh of relief. It's Friday. The Nasdaq 100, very tech-heavy index, up more than 3%, as you said. Biggest jump since March of 2021. Not quite as impressive as the S&P 500, which had a really strong day, best since June of 2020, of course. But you look at how mega caps perform. The NYSE FANG Plus index up also 3%. Apple, a massive part of that. The only stock in that group not to make a gain was Netflix, down 0.6%. And semiconductors getting in on the act. Semiconductors performed so poorly relative to the rest of the subsectors within technology so far this year. And Bloomberg Galaxy Crypto Index also getting in on the act, its biggest jump since November. So it's a really positive way to end the week, Caroline. I'm not trying to upset you. I'm not trying to bring the mood down, but come with me into my Bloomberg terminal, because you mentioned this in the intro. Let's think big picture here. The Nasdaq 100 is on track for its worst month since 2008, the financial crisis. I was a little bit younger then, but that chart says it all, doesn't it? You know, what we're dealing with at the start of 2022. It's the outlook for rates and those high multiple stretch valuation tech stocks, particularly in the software sector, that we're worried about. The question, I guess, is, was Apple's big print for the fiscal first quarter, period ending December, enough to turn the tide? Well, this is Apple, right, over the last 5 days. You look at that jump, and the superlatives are amazing. This is the biggest jump for Apple in some time, but it's the biggest post-earnings jump since July of 2020, when they posted their print for the period ending in June of that year. So clearly investors are happy about something. The question is, will they be happy next week?
Yeah, and maybe some not happy about this reversal on a Friday. There are people who are short this market, of course, but currently, right. I mean, a phenomenal move for Apple. Biggest one-day move since July the 31st. 2020, Ed. Great wrap-up of an extraordinary week. And we'll get to Apple in a moment. But first, I want to take a look at a very volatile week, as we were just saying, led by the tech stocks staging a bit of a comeback. Well, a man who might be a little bit gloating about this shift to value is Bill Smead, CIO of Smead Capital Management. And this is a story. Yes, today the Nasdaq performs well. But in general, January has been a story of movement from growth into value.
It sure has. And the worst thing you can have is these violent up dead cat bounces. They went on for, from March of 2000, they went on all the way through to 2003. So I don't know what you should wish for there. I think if I were bullish on tech, I'd want them to form a sideways bottom for 6 months and build some kind of a base, because these abrupt rallies are more symptomatic of a bear market.
Interesting. I mean, a lot of people saying today's action, at the end of the week, sort of swift reversal, is in some way a look ahead to the fact that we're rebalancing for the end of January after an extraordinary sell-off month, that perhaps people are just trying to reallocate their portfolios ahead of that end of the month that we get on Monday. If this is a dead cat bounce, where to hide? I mean, you're a man who's sat on the West Coast in Seattle, but you're really looking not at the tech players. You're someone who thinks, look, time is now ripe for the energy trade, for example.
It's bizarre. People were more excited about oil at $65 a barrel in 2018 than they are about oil at $88 a barrel, when virtually everything involved has driven scarcity. You know, we used the example of cigarette commercials being banned in 1970, and over the next 40 years, the number of adult smokers in the United States got chopped in half. But Philip Morris was the best performing stock on the New York Stock Exchange in those 40 years because the price of a pack of cigarettes went from 20 cents to $5. And that's basically what we're doing. The massive amount of money flowing into ESG investing has overcapitalized innovative clean energy needles in a haystack and massively undercapitalized the future success of the oil business.
I just think it's an extraordinary time, really, to be looking at this market and understanding whether the US as well is the place to be remaining to put your money. The US dollar on an absolute tear. Of course, this is as we see a Federal Reserve get more hawkish as we anticipate those rate hikes. But what is the story of the dollar and whether or not you should be looking outside of the US?
Well, we just started a international fund ourselves, so we're a little bit biased about the SMED International Value Fund. So stocks are cheap outside the United States because most of the glam tech is not outside the United States, just like in 1999, most of the glam tech was not in the United States. We think making cars and producing oil and owning land and building houses and things that benefit from inflationary attitudes are where to go, not chasing the next dream of someone that hopes to create the next Netflix or Amazon.
We're looking at a dollar index up 0.7%. You talk about basically inflation hedges at the moment, but at what point, Bill, does Apple, Microsoft, Amazon, these tech heavyweights become, again, a place of safety, a haven, because they were the haven trade, and their margins are such that, and their balance sheets are so clean to a certain degree that you would have thought they could still be the safety trade?
That was the question asked in 1980 about the oil stocks when they were popular. That is the question in 1990 about the Japanese stocks that made up most of the top 10. That was the question asked in 2000 about the top 10 holdings, which were mostly tech. And that was the same question asked in 2010 about the Chinese stocks that were, and the Chinese beneficiary stocks like BHP Billiton that everyone was asking that question about. The problem with asking that question is by virtue of the fact that you're asking that question, you're inviting poor investment results the following 10 years by trying to make it be so. Just accept the fact that you'll never see tech more popular than it's been in the last 12 months.
Wow. Fighting talk, Bill Smead. Going to get a few writing in from that, I'm sure. CIO of Smead Capital, stay well, have a wonderful weekend. And of course, we want to get back to the Apple story now. Ed was mentioning the shares up. I mean, phenomenal move. Haven't seen that sort of a move since July 2020. Much better than expected results. Joining me now, Mark Gurman, who, of course, follows Apple the most closely of all people we know and breaks scoop after scoop. What did you make of the share reaction? What do you make of what you heard on the call from Tim Cook and the executives?
Thank you, Caroline. Well, the share reaction makes a lot of sense. It's well-deserved, right? These numbers were absolutely stunning, right? I think everyone expected that Apple would beat its guidance, right? Apple's guidance was that they would come in higher than the $111.4 billion from the year-ago quarter, but nobody really thought they would win the game by that many points. Nobody thought they would smash that by about 13, 14 billion, which they did. Extremely strong performance for the iPhone 13, despite it being a modest upgrade. Clearly, people still want to get their hands on 5G. Clearly, there's still a lot of upgraders. The Apple Watch and the AirPods did fairly well, despite the fact that these were pretty, incremental upgrades from the year-ago devices. And so overall, very, very strong performance, other than two minor flaws with the iPad in Japan, when neither of those are especially core to the company's overall portfolio.
We had a great conversation previous to this on our triple take conversation about supply chain woes. They're actually getting worse. The Port of LA, where you currently sit, looking more ugly than it ever has. How has Apple managed to navigate that so well?
Seriously impressive. My take is that it's so fascinating that you see Tesla and other companies saying this is going to go on through the year into 2023, and you have Apple saying it's really easing up this quarter. Well, my take is that Apple has extreme pricing power, and they draw the most volume for these supply chain partners, right? In Taiwan, in Japan, China, elsewhere, in Asia, Vietnam. And what they're able to do is get these suppliers to really put them front and center, put them first in line when these components are available. Because a lot of these suppliers, they generate the bulk of the revenue from Apple. So of course they're going to choose Apple when their supplies are ready to give it to Apple versus a Samsung, versus a Microsoft, versus an Amazon or a Meta or another partner, right? Apple's going to be at the front of the line. They also have a very strong operational structure, right? They have people on the ground in China already throughout the pandemic, even when you were not able to travel, in order to start resolving these issues. So they've been working on this a bit longer than some of the other companies. They've had people dealing with these issues already for 2.5, 3 years. So they have a leg up in terms of pricing power and people.
There are, though, the odd tiny cloud on the horizon potentially for Apple. This one in particular, when it looks at antitrust, the App Store, Epic Games, there seems to be another step being made there in terms of support coming from various attorneys general in support of Epic.
Yeah, Apple's going to just make as much money as it can with its current App Store rules for as long as it can, right? They made, over $60 billion across fiscal 2021. They made a ton of money from the App Store in fiscal Q1 over that holiday period. So they're going to keep generating that money as long as they're allowed to. And once they need to make that fundamental shift across the entire App Store, they will. They probably will take a bit of a revenue hit there, but they're going to make as much money as they can till then, and they're going to invest it. And they're betting on, as the user base expands. Remember, they said they have 1.8 billion active users now as of this quarter. That's up 300 million devices in just 2 years. So the more devices they have, the more people they have buying apps, the more people they have subscribing to services. And so I think they're going to be okay in the long run, no matter what is done to their underlying business.
Ecosystem still going to keep on feeding the beast. Mark Gurman, we thank you so much on all things Apple coming up. It's been a year since that GameStop furor. Do you remember it? We'll be reflecting on the meme stock phenomenon that put, of course, Robinhood in the hot seat and where the trading platform is headed. We're going to be speaking with Regent Atlantic's Andy Capirin. That's next. This is Bloomberg. So exactly 1 year ago, a swarm of retail investors went all in on a few stocks, including GameStop, AMC, following advice, of course, from various threads like the Reddit one, Wall Street Bets. This put Robinhood, of course, the brokerage, in the spotlight and upended many hedge funds' plans who were betting against such stocks. They were short them. What have we learned 1 year later? Let's bring in Andy Capirin. He's the partner and co-chief investment officer at Regent Atlantic, and a man who, we all remember kind of where we were amid the meme stock frenzy. It was an extraordinary story. But what are the aftermaths? Is retail still a bigger player now than it was then?
No, it's a much smaller one. And I think one of the reasons it's a much smaller one has everything to do with GameStop and how it played out for the smaller investor. It wasn't until the news had already broken, it wasn't until GameStop was already up significantly that the typical retail investor opened up a brokerage account, did their first options trade, which was typically a deep out of the money call option on GameStop. If they were lucky enough to be one of the first few, that was a lottery ticket that paid off. If they were unlucky enough to be one of the last few, it's been a slow grind down in the stock price of GameStop over the course of the past few years, the past few months. And I think what it really is going to do long term is discourage that investor whose first experience was this lottery environment to become a long-term investor in the stock market. And that ultimately is bad for everybody. It means fewer investors in the stock market, less liquidity. It means that they won't use this engine of wealth creation for themselves, perhaps until they've had a re-education.
Perhaps they're not picking individual stocks at quite the same clip as they were. I mean, there's still, I think it's something like 17 million people using Robinhood. There's still an awful lot of assets that they have that they certainly store. And is there an element that people are now putting money to work in funds. They're putting it into work in ETFs. Is the retail investor just perhaps not picking individually anymore?
So Robinhood is an interesting part of this story, the ETF and individual stock story, because for many, many years, people have been putting most of their assets to work into index funds. Tax efficient, easy, don't have to think about it. You get an instant diversified portfolio. And then Robinhood broke the brokerage industry by offering free commissions. And there's a magic to free. Before Robinhood did this, commissions were $10 at some brokers, $5 at another. Not so much that it really makes a big difference to, say, a $10,000 trade, but it makes a huge psychological difference to make something free. That is, there's a certain magic to free. And I think what Robinhood has done is by forcing the other brokers to get to that $0 commission level, they are encouraging investors to trade more individual stocks. Now, all of a sudden, you have to think about it a little bit harder, but because it's free, that inhibition against doing it has gone away. I think more investors are investing in individual stocks. That has a lot to do with the market dynamics that we've seen over the course of the last 2 years, with some of the individual names that were popular with retail investors first experiencing a huge spike in their price and then a very rapid decline, especially over the course of the past 3 months.
Where retail has perhaps forced change is the behavior of certain hedge funds to go short, and to the extent that they go short a certain stock. Do you think that will have long-term impact, Andy?
I think it will, and I think it has in a couple of really meaningful ways. One is it'll permanently change the price of options. The people that were caught short in GameStop and in some of these other stocks. One of the reasons they were caught short is they simply overextended themselves, took too much risk. But one of the reasons that they got caught short is they didn't apply enough protection to the trade. You could have bought an out-of-the-money call option yourself to protect against this kind of eventuality. They didn't feel they need to. And I think that's permanently going to skew the price of out-of-the-money call options, especially on smaller, less liquid, volatile stocks. I think the other way that this changes hedge fund behavior is it's going to make them under-eager to run a fully balanced long-short book. They might maintain a long bias, even if they don't necessarily feel bullish about the stock market overall, because it's just so dangerous to be caught short in one of these stocks.
Really interesting ramifications, and well, perhaps a little bit of humility and hubris across the board, really.
That's right.
Region Atlantic's Andy Caperin, we wish you well. Have a wonderful weekend. Meanwhile, coming up, it's a fight over the First Amendment and trademark infringement. What a case involving Meta Birkins could mean for the emerging NFT market. That's next. This is Bloomberg. Let's follow up on a headline that we mentioned earlier. The UK government has approved the extradition of Mike Lynch to the United States to face criminal fraud charges. Now, this comes after a London judge ruled the tech tycoon was dishonest in that $11 billion sale of his company. Now, the extradition decision by the Home Secretary was issued Friday, but Lynch is unlikely to be getting on a plane anytime soon. He can appeal a court's decision to allow his extradition. It's the latest in, well, more than a decade of twists and turns following the 2011 sale of Lynch's company Autonomy to Hewlett-Packard Enterprise. A year after the sale, the HPE, of course, wrote down the value of that deal, some $8.8 billion. Now, to another legal one that we're watching. It's a fight that could potentially end up front-running the US Supreme Court. It could end up being there. We could see an upending of what is the ways in which we think about NFTs, in particular, Hermès Birkin bag versions. The luxury French designer is suing the maker of the non-fungible tokens over trademark rights. Let's get to the bottom of all of it and joined by Bloomberg Law Samantha Handler. Now, take us back a step. This court case, it's all to do with the fact that these non-fungible tokens get sold of digital Birkins, but without Hermès's say-so.
Yes. So Hermès is claiming that Mason Rothschild has infringed on their famous Birkin trademarks with his Meta Birkin NFTs. Hermès is saying those NFTs are diluting their famous marks. But Rothschild says his First Amendment rights protects him in selling these NFTs and has compared the situation to Andy Warhol's paintings of Campbell soup cans. And this might give courts or even the Supreme Court the chance to clarify the legal balance between trademark rights and the First Amendment.
Your view on how courts usually balance these sorts of trademark rights versus the freedom of expression?
Right, so courts have said these types of cases should only go in favor of the brand if the trademark has no artistic relevance to the work, or the artist is explicitly misleading consumers on the source of the work. Appeals courts are inconsistent on how they apply this test, and it tends to favor artists. Attorneys think Hermes might have a better shot, though, because consumers might be confused about whether or not the actual Birkin maker is associated with these Meta Birkins. So many other brands have gotten into the space, like Adidas and Louis Vuitton.
Yes, of course. The fact that many a company right now wanting to ensure that its presence is felt in the metaverse, Nike, another key one. I'm interested in the guidance, the potential guidance coming out of these rights. How do you think it will impact going forward? What are people going to be looking for to help dictate future decisions around this? And how can companies in particular potentially front run this so they don't end up in court but end up part of the process before it goes live?
Right, so companies can start filing trademark registrations in proactive categories that might cover NFTs. There isn't any specific category right now that does cover NFTs. But that's one way they could try to get ahead of it, or just go ahead and collaborate with artists right from the start, like Louis Vuitton has. Otherwise, people are watching this case to see if the Supreme Court or another court does clarify this test that might give brands a better outcome for these cases.
Is this the first major legal action that we've seen?
Yes. So there have been other suits involving NFTs and artist rights, but Hermes is the first large company, really high-profile plaintiff to take on this case, which is another reason it might be enticing for a court like the Supreme Court to eventually take on.
Bloomberg Law's Samantha Handler. It's going to be fascinating what sort of precedent it does indeed set and how people start to try and get ahead of the curve. We want to thank you. We've got so much more actually coming up on the crypto space. We're talking about being the future of business, potentially. Michael Shorlove's going to be joining us, CEO of cryptocurrency custody firm Fireblocks, about why he believes every business will become a crypto business and how they can protect it. This is Bloomberg. This is Bloomberg Technology. I'm Caroline Hyde in New York. And it wasn't just tech stocks that had a pretty wild week. Crypto in on the act as well. Bloomberg's Ed Ludlow back in the action for us and talk to us through what the week that was.
Yeah, I mean, volatility was the buzzword. And I bring up this board, right, where I'm showing the Bloomberg Galaxy Crypto Index. Of course, it only trades Monday through Friday, largely a heavy weighting of Bitcoin, Ether, Ethereum, and then some other tokens as well. And it's interesting because Friday, Bitcoin pushed higher after we saw that equity market late push or rally towards $38,000 per token. But, over a 1 week basis, Bitcoin's higher, Ethereum lower, and the NASDAQ 100 basically flat along with equities. So in a week where we had a Fed meeting, we get key earnings that have driven sentiment in the equity markets. I ask you once again, Caroline, what is Bitcoin? Come with me into my Bloomberg terminal and let's ask the question, because we've been looking at this chart for a long time now, the kind of correlation between the NASDAQ 100 and Bitcoin, okay? The correlation kind of remains high, it drops back down, it comes back high, risk on mode, risk off mode. What is it that we're thinking about here? And it is a question to continue asking guests, because Bitcoin did drive higher throughout the week, especially when Jay Powell made those comments right earlier in the week that he could even reassess his own inflation outlook for the year, maybe add a few tenths of a percent onto that. But I'm still confused. I'm not quite sure where I stand on a day where we're risk off, quote unquote, in the equity markets. Bitcoin's kind of starting to behave its own way a little bit.
Yeah, digital gold or a risk asset? The argument continues. Ed Ludlow, we thank you for that breakdown. And let's just stick with the world of crypto right now. DeFi lending firm, that's Qubit Finance, just saw Well, another $80 million worth of its digital assets actually wiped out, latest in a series of hacks for crypto trading marketplaces, which have left investors frustrated, companies suspending services to fix network vulnerabilities and the like. All of this can be a hindrance to the overall growth of the ecosystem. But let's talk about how you can prevent that. Cryptocurrency custody firm Fireblocks is with us. Michael Sholov is joining us. And Michael, I mean, first and foremost, we want to congratulate you on the fact that you've just had a mega new funding round, new market capitalization that rallies significantly in the private markets because more people want to be putting money into your business. Talk to us about the growth, because you've been adding more and more companies to help, with the custody, with the protection of their crypto assets, right?
Yeah, that's exactly right, Caroline. So, what we do, we basically provide a custody infrastructure for financial institutions, mainly fintech firms, banks, and other financial intermediaries that eventually either they're using this service for themselves, or they're basically creating white label solutions for consumers, for retail clients. As you can imagine, there's more and more interest clearly in crypto. 2021 was an amazing year overall for the industry. Our client base went from 100 clients, 100 institutions that were using us at the beginning of that year to over 800 where we finished 2021. And that's because all of those clients want to make sure that they have access to the most secure and well-protected infrastructure.
And maybe that's why, of course, your own market capitalization goes up to something like $8 billion. It's the likes of Bank of New York Mellon, Revolut. We're looking at some of the companies that you help support. Galaxy Digital itself. We were just talking about that crypto index that we sort of share with Galaxy Digital. I'm interested in whether you move outside the world of financial players, whether at the moment is the low-hanging fruit financial institutions that aren't yet offering a crypto offering that would become your future clients, or is the world your oyster?
Yeah, so actually, much to our surprise, and I must admit that the NFT sort of phenomenon also caught us by surprise, but because we've really invested in infrastructure for DeFi, and for those who are not so much familiar with the industry, NFT and DeFi, they have a very similar infrastructure. We were also well positioned for NFTs. And while we still see most of the momentum inside of the financial sector, in the last couple of months, we start onboarding customers that are really outside of the financial industry, mainly companies that provide gaming. So in the gaming industry, we see a lot of momentum. Clearly, it's sort of correlated to the metaverses. I think there is a pretty interesting future to both gaming and metaverse, where NFTs really play a big role. And also other businesses such as marketplaces where they are sitting in the middle of those transactions and they can greatly benefit from this technology. So we're definitely seeing right now the expansion of the services that we offer to, just generally speaking, businesses. And I think that over the next 5 to 10 years, we will see basically most of the businesses leverage this technology for just value that they create, content that they can tokenize. It's very interesting.
I mean, of course, we've been hearing a lot of the world of NFT combining with YouTube, with parts of Alphabet, which interestingly, the VC part potentially, Capital G is obviously related to Google. How much are some of the investors that you're currently bringing on, Capital G being one of them? We were looking at some of the other ones that you've been with, Spark Capital, D1 Capital. How are these companies sort of thoughtful for you in terms of being strategic investors?
Yeah, so first of all, I think those are some of the powerhouse VCs that for a fairly long period of time, they were actually not in the crypto. They were not investing in this industry. And I think in the last year or so, they sort of started to pay attention and invest in companies like ourselves. Clearly, with some of those names that we mentioned, there are strategic discussions that are on the broader corporate strategy that they have. I think that many companies, basically like in all the big Web2 companies, that they have a lot of content that is generated on their platform or gaming. Google is one of them, Microsoft, Amazon, and many others, right? They are thinking about their strategy. What are they going to do with digital payments, and what are they going to do with NFTs? And having those people and those folks on our balance sheet and aligning with them strategically definitely helps with having those conversations. Also, to be honest, we like to be strategic partners and sort of thought partners to a lot of those people, because given the fact that we see what's going on in the industry today, and we are working with many of the innovators, many of the startups that are really developing the new things, we can help them to understand how exactly it works and what ideas really are really meaningful for them.
What about, well, legislation? What about the ways in which currently not only the United States government, but worldwide, that institutions are looking at the development of crypto and understanding how to regulate it?
Yeah, I think that there is a lot of regulatory push in the last year or two. I think that overall the narrative in the cryptocurrency industry actually changed to welcome the regulation, right? As long as it's basically aligned with the technology. Because what we believe, and I think many others starting to believe, is that there is actually a better way to do consumer protection, anti-money laundering, and all the important things that regulation brings inside of the crypto ecosystem using crypto tools. So one of the things that we've actually done recently, we created a DeFi marketplace with a company called Aave that is enforcing sort of permissioned regulatory screening on the edges of that market, and allows a licensed institution to participate in DeFi, which before that was sort of impossible, because as a licensed institution, you couldn't actually figure out if you're going to undermine any off-act regulations or things like that. So overall, I think that there is a pretty interesting development on that front, which will be positive to the industry.
Fablock CEO Michael Sherlock, great to have some time with you. Thank you for making the time after that fundraise, talking all things crypto. Meanwhile, coming up, it keeps getting, well, better, but we still aren't where we need to be when it comes to diversity on boards. My next guest is working to try and fix just that, starting with how companies even search for candidates. That's next. There's a Bloomberg. A story we want to update you on. SoftBank COO Marcelo Claure, he's out. He's been with the company for the last 9 years. Michelle Combs will become the CEO of SoftBank Group International. In a statement on Claure's departure, CEO Masayoshi Son said, in part, Marcelo has made many contributions to SoftBank during his time here, and we thank him for his dedication and wish him continued success in his future endeavors. Bloomberg had learned, of course, that Claure was looking for as much as $1 billion in compensation. Now, let's talk about what a record it has been for actually women in 2021. When it comes to board seats, they gained more than 100 seats in S&P 500 boardrooms last year. But still, a lot of work still to be done, especially when it comes to the process of how companies look for board members and how we can drive true diversity, not just on a gender basis. Abby Elderman's with us. She's CEO of BoardSpan, plenty of expertise when it comes to advising boards, when it comes to strategies, governance, of course, what you were previously doing M&A and the likes for them. I'm interested in those steps being taken. We're now seeing just sub 31% of board seats in the S&P 500 held by women. That's below Europe, below Australia, but still an improvement. Is it sustainable improvement?
Caroline, that is absolutely the right question to jump in on. And I just want to start off by saying that this whole issue of diversity, and people say, well, why is it important? Are we just trying to meet some regulatory requirements or tick some boxes? And in fact, it is really core to what makes for a successful board. And that's the whole reason BoardSpan exists. So diversity is a really important part of the equation, but it's really trying to create boards that contribute more to all of their constituents. As far as the question that you posed on the 31%, it's great progress. But there is some risk of sort of being asymptotic and having those numbers flatten out a little bit, because you have to think about the different pressures. How did we get to where we are? What's driving it? And what are the blockers coming forward?
I'm interested in that because we sit here as two white women. And I've spoken at length many a time with the likes of Ursula Burns, who has her own focus on board diversity, and particularly as a black woman, she said, look, white women have made inroads, but people of color haven't. We're starting to see improvement there as well, but not enough to the same extent. I think back in 2019, it was 1.5% of board seats in the Russell 3000 were women of color. That's an appalling statistic. How are we seeing that change?
Yeah, no, it is appalling, and there is progress with a lot more that needs to come. You know, the statistics show us that the people of color, more broadly, what's called the underrepresented communities, are up to 17%, which is some progress from last year. But I think the issue is really people focusing on why do I want to bring this person on the board above and beyond the diversity characteristics. It is so critical for boards to think about the challenges ahead of the organization, their broader definition of constituents that we're sort of all a little bit more woke about, and the challenges they're going to have. And the value of having diverse board members is to get diverse thinking. These are a different set of challenges and problems as the world is changed. We've all experienced that over the last 2 years. And what serves that organization best is to bring what I call a tapestry of thinking. And that's where diversity really adds a lot of value. And I think when it comes to people of color, other ways to consider underrepresentation by gender, and a combination, you're really getting that much more, frankly, sophisticated thinking and less monolithic thinking.
I mean, just think what the Federal Reserve itself has just been through. When we look at the seats of the Federal Open Monetary Committee, Philip Jefferson just being added, a black man who, of course, not only we think about a diverse in terms of statement, what we see, but also the intellect that he brings, the writing he's done when it comes to poverty, when it comes to coming from different backgrounds. Lisa Cook being added at the Fed, Sarah Bloom Raskin as well she comes with a wealth of experience when you come to environment as well. How do we build that sort of thinking in an earlier time? I mean, the Federal Reserve has been under a lot of pressure itself because it needs to think more from a more diverse, inclusive nature from the labor market. How are people being set from a pay perspective? Are we starting to see real, tangible needs being put on executives to ensure that they think in a diverse manner?
Yeah, there's a few things going on. And you know, I think there was a little bit of a tipping point when the Business Roundtable redefined who are the constituents and saying it's not just all shareholder primacy. Obviously, investors still play an important role. But when we think about the critical importance of a board's responsibility to employees, to customers, to the planet, that's making us realize we need that talent that brings that additional expertise, that broader perspective. So I think that is one of the considerations that goes into it. But there are other things that are going to help move that along. And then fighting it, unfortunately, on the other side are things like, this really interesting NASDAQ rule that came out last year. And now it's up to 17 states AGs that have filed suits against NASDAQ. And so now we're saying like, whoa, that's a blocker. What's driving, that's what worries me about how much progress we can continue to make. I still think there's a lot of progress ahead of us. It would just be nice if we continued to have more wind at our back.
And the media need to keep shining a light on statistics such as that, where Charter Communications has 7% of its board as women. Not good enough needs to be sort of the framing. But I'm interested in sort of whether or not people so often say, a pipeline problem. But there isn't a pipeline problem. It's just you have to be more diverse in the way in which you think about the talent you need. It doesn't need to always have been a CEO. It doesn't need to always have been a C-level executive even. How are you seeing people think more broadly about the experience and the expertise they need to ensure that they've got the right people around the table that don't look like themselves?
That's exactly right. So I've always felt that it was a demand problem, not a supply problem. And so we always work with our clients around intention. What problem are you trying to solve? What are the needs? What are the challenges that are going to be coming up, or the opportunities you want to take advantage of? And with this world getting so much more complex, that's exactly the situation where you're thinking, you know what? Somebody who's really helped grow an international business, somebody that understands business disruption, somebody who's a true product expert. I'm thinking of one of the clients that we're working with, a company that recently went public called Meridian Link, and they specifically knew that what they needed in the case of one new board member was somebody who's really a true product expert. And in the case of their next new board member, somebody who understood how to go to market in financial services. With those two requirements, we were able to put two diverse women, what we call double diverse, on that board in the course of 2 months. There's tons of talent out there. It's about asking the right questions.
Abby, thanks for answering our questions. Abby Adelman, CEO of BoardSpan. Really great take there. Meanwhile, coming up, we'll hear from Ford CEO Jim Farley and Salesforce co-CEO Mark Benioff on what their partnership looks like. They are launching, of course, a brand new pilot project with Ford's suite of electric and digitally connected commercial vehicles. This is Bloomberg. Now, as Ford is in the midst of launching its electric F-150 Lightning pickup truck, they stopped by Sonoma County in California. Now, my colleague Emily Chang, of course, who I'm sitting in the seat for now, she sat down with the Ford CEO, Jim Farley, and Salesforce co-CEO, Mark Benioff, to talk about this new venture, starting with what Ford's new focus on services will mean for consumers. Take a listen.
There'll be kind of customized software that you can pick and choose, as Mark said, off a menu that would make sense for our commercial customers and our retail customers, that makes sense for them. Maybe prognostics or certain kind of telematics like dynamic routing or coaching for the driver if a gas or diesel van. So I think we'll have a subscription like we're so used to, and content, but it'll just be customized based on the usefulness of the data. I don't know if that makes sense.
Well, I think it makes a lot of sense because, you know, when you look at all the opportunities, whether it's opportunities in sales and service and marketing, in commerce itself, in building these custom applications, the analytics, the dashboards, the data, so many of those things that you see here, that, you know, it's not typically how we think about our trucks. But in this case, you know, our trucks are connected. These aren't just trucks, these are connected trucks. Mm-hmm. And the truck is really becoming my friend. You know, I have a relationship with my truck. You know, I mentioned before in my new F-350, I have a new F-350 fire truck. I have a relationship with that truck. I have to make sure that truck is always ready to go because you never know when that's going to be a major issue for you. So I think this is what value-added services out of the cloud is going to offer us. It's going to offer us the ability to be more connected not only to our products but to each other, and we'll be able to do that in every dimension of the business.
Jim, is there a number you can put on it? Like by 2030, how much do you imagine services contributing to the overall business?
You know, I don't want to put a number on it, but I can imagine that, you know, half of our commercial revenue could be either physical service of the vehicle or software. I don't think the answer will be like it'll be software and not the physical service. Mm-hmm. They're totally integrated in our case to keep the uptime 100%. But I could see half.
And obviously, Mark, Ford and Salesforce have had a relationship for a long time. Are you seeing more of your own customers rev up their relationship with Salesforce like this? And what does that mean for your business? Does that help you reach SMBs and new customers that you might not reach otherwise?
All of our customers have a need to connect with their customers in new ways. And when you look at Ford, I think one of the most exciting things about this event reminds me a lot of what Home Depot did with their business. All of a sudden, they realized they had a B2C business, you know, for the consumer. You know, that's me and my Mach-E. But they had a B2B business, you know, their pro business. And when they did that, it was a radical acceleration of their revenue because they realized that is where they had a tremendous new marketing opportunity. And that's what's happening here with Ford by introducing something called Ford Pro. We really have the opportunity to focus on this market segment that's probably the most profitable market segment in the world for this company. And we are just at the beginning of an unbelievable story. And then when you add these comprehensive marketing services, the ability to build a one-on-one relationship with these professionals, to understand them, to be able to provide them the products and the services that they need, it becomes a tremendous product line over time. Also, you get tremendous feedback on what are the products that they really want, what are other services that they're doing.
Ford CEO Jim Farley and Salesforce co-CEO Mark Benioff earlier this week. Now, that does it for this edition of Bloomberg Technology. What an extraordinary week for tech investors and for Wall Street at large. That's why you've got to tune in next to Wall Street Week. Christina Hooper, Urian Timmer on the wild week in the market. Stephanie Flanders analyzes Jay Powell and the Fed's performance this week, and Barbara Ann Bernard on why it might be smart to invest in carbon and ESG. You do not want to miss it because very own Romain Bostic is helming it this week.